Welcome back to another episode of Paladin Financial Talk. I'm your host, Nikki Foley, and I am with Mr. Tony Short today as our co-host.
All right, Nikki, great to be here. I'm happy to be on the show once again. Great to see you.
And I'm happy to be with you as well, Tony. You know what? We have a guest sitting right next to us today as well, helping lend some extra expertise to our featured topic. So we are wrapping up. We have been talking about long-term care. Yeah. I feel like we've been talking about it for weeks.
I feel like I've been talking about long-term care for 3 years.
Yes, I think you have. I think you have, my friend. Well, let's offer a warm welcome to Mr. Jay Dacey here today.
Thank you.
Yeah, thanks for being here, Jay.
So, Jay, you've been on the show before. I've talked to you before, at least a couple of times, right?
Yeah, I've been here 3 or 4 times. Thanks for having me back.
But usually when you're on, we're talking about real estate, mortgages, reverse mortgages. What does any of that have to do with long-term care?
Well, I thought we would bring Jay in to just see how uncomfortable we could make him while we talk about long-term care. Let's play a little game on him. No, we're not.
All right,
we're talking about reverse mortgages and how reverse mortgages could be a potential option to fund long-term care. So this will wrap up our episodes or our series on long-term care planning. And one of the things, though, that I think is important to say as well is while we'll spend the first part of this talking about the long-term care side of things, Jay is full of information. He's a fantastic entrepreneur in general, but has a lot of information about what is going on right now in the market and what people should expect from real estate and that side of things. And I think that has people pretty excited. So I don't want to say that we would waste our time on long-term care. I think we need to wrap that out, but there's so much that he can offer our listeners about what's going on with the housing market right now.
Yeah, see what I can do.
All right.
Yeah,
Sounds
I'm
like
curious as to the housing market and what's going on because it seems like it's been a bit of a crisis mode because of high interest rates.
Yep.
And now those might be coming down, hopefully, right?
Yeah, they've been trending down. And one of the better advices I've got when I was younger as it relates to investing in your 401k, IRA, et cetera, over time, imagine if you're at the mall and you go and buy a yo-yo at the bottom floor and then you start playing the yo-yo on an escalator. Every month you might get your monthly statement, quarterly statement. It might go up or down, but over the long run, it goes up. Starting last fall when we were, mortgages were in the 8% range, we kind of got on the top floor of the escalator. And now we've been playing yo-yo the last year plus in the downward direction for rates.
Yeah, that's a good way to look at it. Well, I know that we don't want to miss this opportunity since we have you here with us. So we'll get through this reverse mortgage side of things, and then we'll dive into that. So I prepared a list of questions if you're good with us doing kind of a question and answer type format here. But I think it's fair to just start with what is a reverse mortgage and give us a little bit of history on reverse mortgages.
Yeah, so the reverse mortgage product has a lot of negative connotation in the marketplace, and rightfully so. The original product had some features that were not super consumer friendly, and over time, the government has revised the policies and guidelines to eradicate some of those things. I'll just give you one example. The original product, it's based on your age, your home's equity, and the current interest rate environment. So the older you are, the more equity you have access to. The lower the rates are, the more equity you have access to. And what happened with some of the first people, if you've heard people like grandma lost her home to the county, it's because the original mortgage was set up so that a person that was getting one could max out their equity at closing and take all of their equity out right up front. And they were not underwritten to see if they had any ability to repay because you don't have to repay a reverse mortgage. The interest can just accrue. But what people in my shoes forgot to tell those folks when they got their mortgage was you still need to pay your taxes, you still have insurance, Xcel Energy is going to send you a bill every month. And so they essentially took all their equity out at the point of the transaction. And when the county taxes came due, they didn't have the funds available. And so now we actually underwrite the clients to take a snapshot of their income. And if it's shown that they don't have sufficient income to pay for things like taxes and insurance, there's something called a LISA. It's a life expectancy set-aside that we carve out from their available equity. And so a lot of listeners probably have escrow accounts that you pay into every month, and then the county pays your taxes and insurance when they come due. The LISA essentially takes your equity aside, and you don't have to pay into the equity account. It's already set aside at closing. and then the mortgage company will pay the county the taxes and the insurance company the insurance when they're due. So that version of the product is one example. There's a handful of other ones, but we won't go into that much detail.
Protecting us from ourselves is what it sounds like there.
Exactly.
Yeah, because you still have to pay property tax.
Taxes.
And a lot of people have that wrapped up into their mortgage payments. So when you do a reverse mortgage, I think that's where people used to get in trouble. If you hear negative things about reverse mortgage, it's like, oh, somebody's grandma lost her house because of a reverse mortgage. No, it wasn't because of the reverse mortgage. It was because she stopped paying property taxes.
Exactly.
And then didn't have the money, spent the other money, and didn't have money for property taxes.
Correct.
Is that what you're saying?
Yep.
Yeah,
Okay.
what good perspective or summary there, Tony. I think somewhat of this applies back to some of the long-term care insurance we talk about and how it also has a negative connotation because it wasn't structured correctly or it was misquoted in the pricing side of things. And so then all of a sudden it becomes something that people don't want, where in fact the need for long-term care is still there. It just may not be an insurance policy and the traditional long-term care insurance that people have known. And so you have a need for it, and especially if you look at the number of boomers that are continuing to age and going to need health insurance, or are going to need care, therefore some way to pay for this health insurance along the way. Like, the industry has to continue to evolve to make sure they have products and services that meet that, and that's no different whether we're talking about long-term care insurance of some sort, whether it's a hybrid situation or a reverse mortgage. They have to meet the needs of what our aging population is going to be facing.
Agreed.
Which is significant cost as it relates to their long-term care planning. Okay, so we know in general what a reverse mortgage is. There are lots of different kinds. Is that a fair thing to say? Or give us a summary of that. You don't have to go into too much detail.
Yeah, so there's essentially 4 options. There's really 3 options in a hybrid. So you can either set up a monthly distribution. So based on your age and interest rates at the time you take the reverse out, the actuarial tables are what they are, and you get X amount per month until you pass or until you sell the house. That's what most people think about when they think about reverse mortgages, is getting a monthly check from the mortgage company. That's probably the least popular option. The second other option is you can get a lump sum of cash at closing. So that's it. You get the money at closing, and that's it. You're done. The third option, which is the most common, is to set it up as a line of credit. So
like a HELOC, like a home equity line of credit?
Similar, but it's got some features that make it more attractive. So a HELOC, if we go through what we went through 15 years ago, 16 years ago, like the 2007, 2008 meltdown, I had clients who had HELOCs that were frozen. Like, the home equity came down and the second mortgage lenders were underwater, so they froze those lines of credit. A reverse mortgage will never be frozen, and actually it continues to grow over time. So the available credit grows equal to whatever the interest rate and the PMI are. So, for example, just keep it simple, if you took out a $100,000 reverse mortgage, interest rates and PMI were at 7%, the line of credit would grow to $107,000 by year 2. So it grows over time, whereas a HELOC stays a fixed rate typically.
Okay.
Interesting.
So since we did talk about HELOCs, tell us who is right and who the demographics are for a reverse mortgage so we can compare and contrast that as well.
Yeah, so the most popular one is a HECM that's FHA insured. For that, the main requirement is that you're 62 years old and that you have sufficient equity and that your property meets FHA requirements. So single family, you can get a 4-plex. If you have a condo, the condo just needs to be FHA approved. And so it could be basically any 1 to 4 unit house that is in good repair. If your Aunt Shirley hasn't maintained her house and the roof is in need of repair, they can take aside money at closing to fix the roof to get it up to FHA standards. So if there is problems with the house that need to be updated, we can definitely set that money aside at closing for the contractor so that person can get their mortgage.
So one of the reasons that people associate reverse mortgages as being an option for long-term care planning is the age 62, though. This really is a design for an aging population.
Agreed, yep. And the interesting stat is there's approximately 10,000 people a day in the U.S. turning 62.
Yeah, I just read, in fact, this morning, they said over 11,000 people a day will turn age 65 every year or every day
Yeah.
in just the U.S. So, and I believe it's 62, so it's about the same number, I'm sure.
Yep.
Yeah.
Just wild. So, knowing that, are you seeing a greater demand for reverse mortgages, or is this something that the population's still catching up, that this is an option for an aging population?
Great question. So I think the overall tone is that there's still that negative stigma because people don't realize that the product has changed. But what we found is that once somebody does it and they're happy with it because it gives them a little bit better lifestyle, after a certain point in time, they're comfortable with it, and they start telling their friends at bridge or at pickleball.
Sure.
And all of a sudden, I think it's just going to kind of be like a wildfire. Like once it catches on, it's just going to go. And I think the term is like people aren't comfortable with their neighbor knowing that they have a reverse mortgage because they think it's like a last resort for financially destitute people, which it used to be, but it's not anymore.
I might ask you some questions that you have no idea the answer. So
Okay.
just be like, pass, we're moving to the next one. Do you find that this is something that the carriers or the providers of the reverse mortgages, are they doing advertising and a lot of PR to get this information out there, or is that not even happening yet?
So if you tune into TV on Saturday or Sunday, you'll see a guy named Tom Selleck.
Yeah.
That's about the extent
the mustache.
of it. The mustache man, yeah.
Yeah, yeah, and I think it's the mustache that sells it. I mean, you have to trust the mustache,
Of course.
right? Yeah, Magnum PI. I mean, who's not gonna do what Magnum PI tells you to do?
Yeah,
right.
I mean that is literally what people say when reverse mortgage comes up. It's like that's what Tom Selleck sells on Saturdays, right? It's like that's the extent of what people know about it. Is what Tom Selleck has told them.
That's all I knew about it until recently, but it has come up in more and more conversations. I don't know, maybe it's because I'm getting older, but I think it is already. We're starting to see a wider base of people say, "Hey, this makes sense," especially because they have long-term care costs. Like my dad is looking at it because my mom has long-term care costs. She's in long-term care. He's in assisted living, but he still has the house. And, but you have to be 62 or older, right?
For the FHA insured product, there
Yeah.
are some proprietary products that will go down to 55, but those are like secondary. They're not super popular, but they're available.
So I could qualify for some.
In 15 years, you could.
Good answer there, Jay. Good answer.
Yeah, good answer.
Okay, I had another question about it, but why do you think there's not more advertising, I guess, before we wrap that up? Any insight behind that?
I think it's kind of like a grassroots thing. I don't know that you can go to market on a widespread scale and convince people something. But if you go to, like your company, financial planners, when you're sitting down with your clients, you can present it to them. And if it's coming from you, it's like you're a trusted source. Okay, this is legit. My financial planners tell me about it. If I get a postcard in the mail or I see, a mustache guy on TV on Saturday, there's not as much legitimacy to it as if your financial planner, your CPA, or another trusted advisor talks to you about it.
That's a good point, and it's really a financial vehicle or tool for retirees. It's another retirement vehicle that gives possible retirees and retirement planners another option to say, oh, this is your situation. You know what would work best for you here is a reverse mortgage. Or, sometimes it's an insurance product. Sometimes it's an investment. Sometimes it's bonds or mutual funds. And sometimes it might be a reverse mortgage.
Yeah, absolutely. All right, one more question, Jay, that I now remember, and it's really more out of my curiosity than it is out of anything. What about more the demographics? Is it rural versus urban? Anything like that comes from your education that, I don't know, that might be applicable?
I don't know if I can answer that correctly. I do know that there's certain geographic areas near St. George, Utah. A friend of mine is there that he only does reverse mortgages, and he's doing 20 to 30 loans a month to help people.
Wow.
But it's just like their population has accepted it, and they've come to realize the coin the term that I've coined is it's the Swiss Army knife of mortgages and retirement planning, because it's got so many different tools and options that you can use it for. And it's not just like a one size fits all, but it's like a Swiss Army knife. Like everybody should consider buying one and having it in their pocket for a number of reasons.
Okay, so let's go into when you say buying. Now you're just keep prompting more questions here. So when you say buying, so it's a loan.
Correct.
So talk about when you say buying, what does that look like? I'm selecting something, my options off the shelf here.
Yep.
Just kind of give me the details of fees and interest, and what are those variables that I would be selecting?
Sure. The fees can be a little bit higher than anticipated. It's 2% of your home's value. is what FHA takes to insure the mortgage. And then the rest of the closing costs are the equivalent of getting a regular, 30-year fixed rate. So they range from 3.5% to 5% of the home's value.
What any other variables that like payback terms and taxes and like all the different pieces that go into this? Anything to talk on that side of things?
So generally speaking, there is no payback. The interest can accrue as long as you are in the house or as long as you're alive. You do have the option to make payments. So if you've got some money coming in and you want to have access to a growing line of credit, you might want to just pay the interest only and keep the balance flat. But every year that available credit limit's going to go up by 6, 7, 8% depending on what rates are at. So the main variables are the age, the current interest rates, and then how much equity is in the house. And that's about it. And that's the nice part is whether you have a 580 credit score or an 850 credit score, the terms are the same.
Okay.
Interesting.
Back to what you said about your friend in Utah and the grassroots efforts, it really probably is how much attention is being brought to it and how well they're circulating the information. And so even if you're not hearing about it, it doesn't mean that there isn't really good resources probably in your community. It's then starting to dig in. For sure.
Yeah. You just need to be sat down and show you what the options are. And what I love to do is just say, what do you know about reverse mortgages? And the first answer is usually you give your house to the bank.
Okay.
That is the most common first thing out of somebody's mouth when I ask them what they know about it. And it's the same as if you were to take out a mortgage, well, your loan is collateralized by your house. But as long as you continue to live in the house, they're not going to call the note due. It's just like as long as you make your payment on your 30-year fix, they're not going to call the note due. So you're not really at risk of losing your house. And I'll just touch on a couple other things just because your listeners probably want to know. At the end of your term of life, when you pass eventually, there's essentially 4 options. And if you have a piece of paper and a pencil, just draw a quadrant and put yes, yes in the upper left, no, no in the bottom right, and then a yes and a no and a yes in the other corresponding quadrants that are blank. And so the answer to yes, the family wants the house. Less than 2% of homes stay in the house. I'm sorry, less than 2% of the homes stay in the family. So if the family wants the house and there's equity, they simply refinance, they would go out and seek out new financing and pay that balance off. Or if mom and dad pass and they had sufficient assets in their 401k or life insurance, you just use those funds to pay off the balance and the house is yours. The yes, no, yes, they want the house. No, there's not equity. This is the most surprising thing is because the family wants the house. If there is no equity left, you don't have to come up with the difference. So if the house is worth less than what you owe, you don't have to come up with a difference. FHA does an appraisal on the property and you can purchase it for 95 cents on the dollar. So if the house is worth $200,000, mom and dad owed $300,000, you would be able to pay it off for $190,000. So why is that? Because that no option is slightly worse for FHA and the banks is if you don't want the house and there's no equity, they're going to have to sell it and pay a realtor, 6, 7%. And so they actually wind up letting even less. And they want you to keep the house if you can. So the banks don't want to own your house. And then the last thing is the yes, no. Yes, there's equity left. No, you don't want the house. That's going to be 90% plus of families. You hire a realtor, you sell the house, you pay off the balance, and then the heirs distribute the rest to themselves.
What a good activity to go through with someone so that there really is a true evaluation of what are we doing here. And it's quite thorough in what you just did. You're so good at giving videos and having resources. Is that something you've ever done in a video and have available for people to watch?
Yeah, if you go to our YouTube channel, it's JDC Mortgage Team or Larger Legacy. We have a couple videos on reverse mortgages there.
Yeah, what is that page again? Say it slow. How can people find it?
Our website is largerlegacy.com.
Okay.
Or if you go to YouTube and search JDC Mortgage Team, there's a bunch of mortgage videos.
JDC Mortgage Team.
Dacey.
Dacey.
Yeah.
Dacey. I thought you said, that's why I wanted to clarify it. I thought you said Dacey. Okay.
Yeah.
Yep. Good. So I have a quick question for you. So with interest rates being a topic of conversation lately, and I got a little confused there as you were talking. So is a reverse mortgage, is it better or worse if interest rates are higher? Is it better for a reverse mortgage, or if interest rates are lower, is it better?
That's a great question, and the answer, like, I'm flashback to economic professor in freshman year. It's like, it depends, which is like the worst
it
answer.
Depends. No, that's a lot of cases.
So if you're carrying a balance and you're not making payments, you want rates to be low because the interest is accruing slower.
Makes sense.
If you already have a reverse mortgage in place and you're making payments, or you've paid it down to like $1,000 and rates are high, your available line of credit is growing that much faster. So if you carry a balance, you kind of want them low. If you don't carry a balance, you kind of want them high.
That's why the reason I ask is obviously if you owe something and you have to pay interest, you want lower rates. But you kept saying you can make this money and it grows. So in that case, you want the higher rates.
Yep.
Yeah. Okay.
And you don't have to use that money. Your line of credit just grows, so it becomes available in a year or two from now if you need it then.
Yeah.
Jay, thank you for giving your websites, and we'll add those to the show notes so that people can access them. Any other resources that you think might be valuable to educate our listeners on reverse mortgages? Yeah,
I mean, we're always available for a phone call at 651-315-7681. We're available and happy to chat with you if you have any other follow-up questions.
I do think it's so important, even if it's just an information gathering session, to at least start getting all of the options out there. And that's something clearly that we can, as we're meeting with our listeners and meeting with people, making sure that they can be in touch with you, and we have all of your information at the office. But it's good to explore. It's good to gather your information so that you can have all available information and facts available. So scenario-wise, anything that you want to share of when it really would make sense versus when it might not make sense as we talk about long-term care planning as a start?
Sure. So I think it's, like I said, it's a Swiss Army knife. So everybody's situation is different that you talk to, and the way that they would apply it could be different based on their situation. So let's take a person that has, multi-million dollars in their bank account or retirement account, and they're feeling really good about life, and they've got grandkids, and the grandkids want to go to Disney. And let's say that they've got $4 million in their nest egg, and it's Christmas coming up, and they promise the kids a Disney cruise, and I don't know what that would cost. Let's call it $50,000. And they're going to go to the Disney cruise right before school starts next August. And the stock market comes down 25%, which it does. And June 30th, they get their statement, and that $4 million is now $3 million. And they've got to write a $50,000 check for their Disney cruise. Well, the last thing that they're probably going to want to do is sell their index funds or their Apple stock, whereas they can just draw from their home equity, pay for the trip, and then as the stock market recovers, which it usually does in a pretty quick fashion, then they could consider paying the balance back down or just letting it, keep the balance and accumulate.
Yeah, that makes sense. One of the things that I think it's important to talk about, when you are sitting down with your financial professional, whether it's us or somebody else, we talk about investable assets, not including somebody's home, their primary home.
Correct.
And so I think that's an important thing to bring back to this is as you look at what your nest egg looks like, typically it excludes a home. And so this gives you an opportunity to think a little bit differently about what that nest egg looks like, and an easy way where you're sitting in, it's all your assets are all your values inside the home. This is how you tap it and you get it out.
Exactly. And I think people just need to be given permission that it is accessible, because part of the American dream is to buy the house and have it paid off so that in retirement you don't have a mortgage payment.
Right.
Well, with the reverse, in retirement you still do not have a mortgage payment. You just have to pay the taxes and insurance, which you would have if your house is owned free and clear anyways.
Yeah, absolutely. Anything else that you can think of that is a scenario that you want to share where it might make a fit?
You mentioned the long-term care thing. Your income received, so like we go back to what we talked about earlier, where if you're getting a monthly deposit into your account from your equity, that's like not a very popular option. But if you're one of the people that gets the monthly distribution from the bank, your home equity is that is not considered income for long-term care purposes or Medicare purposes.
Yeah.
But if that money sits and grows in your bank account, then it is assets. So if you're taking a distribution every month, you probably want to spend that money as quickly as you can. Or the other popular product is to purchase I forget the exact word, but it's like a funeral trust.
Okay.
If you're familiar with those at all, but essentially you can prepay your funeral and you could use the money to fund that.
So I think that this is one thing that, so long-term care insurance kind of has a dirty name to it. It has a
Yep.
bad reputation. Talk about reverse mortgages, has a bad reputation. Well, Medicaid can also be something that people don't want to talk about. And that is because, I think there's a lot of, negative connotation that can go along with being in that situation. But I think it's important that we actually start looking about how Medicaid can impact or play a role in people's long-term care planning. And the reality is, with the growing cost of health insurance and health care as you age, it is going to play a role for a lot of people. And so understanding how things interact, like a reverse mortgage interacts with Medicaid, is going to be important. And we can't have all the answers, and it's so unique and situational, but that is a piece of this. And if you already have one, if you're applying for one, all the rules change no matter where that, when you come into them intersecting Medicaid and reverse mortgages. And so, there's people out there that actually specialize in this, and that's elder care, side of our world. And so if people do have questions about when do these two intersect with each other, reverse mortgages and Medicaid, I think that's important to potentially bring in an elder care person along the way as well.
Yeah.
And careful how we say all of this, but I think people don't like talking about, like you said, people don't like talking about that I have a reverse mortgage potentially because it has a negative connotation. That is not the case. I don't think it's going to be, one, because the products are evolving, but two, our world is changing, and it is so expensive for these people that are aging and going into a health facility potentially, and how much it costs.
Yeah, and I think it's just misinformation and misunderstanding.
Yeah.
It's misunderstanding how it works, and it's just utilizing your home equity is what it's doing. I mean, people refinance all the time and restructure their mortgages all the time, and if there's a way you can do that to utilize your home's equity in retirement to benefit you and benefit your lifestyle, I don't think there shouldn't be any negative connotations with that.
Yeah, and it takes shows like this, which sounds funny, but it takes everybody sharing the same story, that this is all about your options that are out there, and how do we look at them to see if it's something that's right for you.
Yeah, and like one other example that you asked about earlier is you can use the home equity to pay for in-home care.
Yeah.
If you need somebody to come and help you make yourself lunch or breakfast or get you out of bed, like you can use the home equity for that, as opposed to selling the house, moving in, and I don't even know what the cost of nursing homes are now, but I think it's like 5 figures a month for most places.
Yeah.
Oh yeah, it is. It's anywhere from $6,000 to $12,000 a month.
Yeah, absolutely.
Yeah.
Well, this has been fantastic to just, hopefully pique some interest in our listeners. And if it's something that they do want more information on, certainly can have the conversations when we're working with them. But what a fantastic resource to have Jay here and his team available to answer questions and start that process if we think it's a right fit for people. We will put Jay's information in the show notes. And if you want to give your phone number just one more time, and then we're going to break into the other side of this conversation.
It's 651-315-7681.
All right, fantastic. All right, so let's get to the part of rates and what's going on in the industry. And just, you can take this really wherever you want to go, Jay.
Yeah, so, last week the Fed cut rates 0.5%, and we had probably 5 or 6 calls that day. Did my mortgage rate go down 0.5%? The answer is rates went up a little bit on the mortgage side of things, and people had a hard time grasping that. And so what I say is, to use a hockey metaphor, Wayne Gretzky said, most players skate to where the puck is. I just skated to where the puck was going to go. Well, the Fed looks at where has the puck been the last 12 months. And so because of that, inflation's been coming down, unemployment has been rising, and those are kind of the two factors that cause the Fed to need to cut rates. And the bond market has been seeing this as inflation's cooling, as unemployment's ticking up, but because the Fed is looking in the rearview mirror, it takes them a longer time for the data to show up where they need to make moves. And a result, you never see a 0.25% first cut. It's always 50 basis point cut because they're a little bit behind.
What a good analogy to add to that. I had to visualize that the whole time you were talking there. So thanks for adding the hockey reference in there. Okay, so what else should people know? So what's their next move if they're wanting to make a change, or what are you suggesting? Whether they want to move into a new house, whether they want to refinance, what's your recommendation for them?
Yeah, so talk with your mortgage advisor, especially if you bought last fall when rates were about 1.5 points, 2 points higher than they were there right now. We've had clients that bought last October that we've already refinanced 2 times because they've been slowly coming down. Again, that yo-yo coming down the escalator, like there's just very short windows of opportunity to take advantage of the current market. And then the next thing you know, rates go back up 0.25%, or rates come back down 0.25%. And it's like, you just need to make a point to be ready to go when that window opens, because it closes pretty quickly. Bigger picture, if rates can trend back into that, 5 to 5.5% range for a 30-year fixed, I think that will help create a lot of volume and activity next year, because there's so many people that bought their house, 5 to 10 years ago. They probably refinanced at 3% or so in 2020, 2021. And if their family has grown or their income has changed, like there's circumstances which might lead somebody to normally make a move. They're feeling like handcuffed to that 3% rate, because a year ago they're at 8%. Yeah. And so people just weren't willing to make the move. If we can see 5.5%, I think we'll see a lot of move up activity, which, if you think about it, if people are moving up, that creates the inventory for the first-time home buyers. So I think it'll be a great thing for everybody if rates come down another, point or so.
Yeah, absolutely. I had given you kind of heads up on this one. We had a client this week that had a situation where they're refinancing, and the individual they're working with said that they can continue to refinance as much as they want in the next 12 months. Is that normal? Are we seeing creative things like that, or?
Yeah. So generally speaking, people in our industry, we have the ability to help cover the closing costs for somebody refinancing. So if you look on, Wall Street Journal or FreddieMac.com, and you see the average rate is 6.125% today. Well, that's going to cost you about 1.5% in closing costs. Well, if you're listening to me saying rates might go lower next year, the thought is like, well, let's just wait. But if somebody's at, say, 7.5%, they can get 6 1/8, but have to pay a bunch of fees. We can probably get them 6.625 and then issue them a lender credit. So they don't get the lowest rate possible, but they go from something in the 7s to something in the mid-6s for free, because we'd cover the closing costs for them with a lender credit.
Okay.
That makes sense.
Yeah, absolutely. You get curious when you hear things. You're like, are we getting creative here? Like, is this, you just don't know what's happening for sure. So that's helpful.
Yep.
I do have to say, Jay, that last time we were on, or maybe multiple times, you gave our listeners I don't know what you call it, but you said date the rate, marry the home. And I have used that so many times as people have tried to decide what they want to do and when's the right time to do something. And so you can expand on that one if you want to.
Yeah, so we had a lot of clients when rates were higher last year saying, I'm just going to wait for rates to come down. And, think about 21, 22 to 23 and 24. If you had asked the average person with a finance degree, what will happen to housing prices if rates go from 3% to 8% in an 18-month window? They're going to tell you housing prices are going to collapse, because nobody's going to want to pay 8% when they can pay 3%. Well, what we found is there's still slight appreciation when rates more than doubled. Okay, so the people that purchased that were brave souls when they got an 8% rate or a 7-point-something rate, they locked in the price of their home that they paid at that point in time. If rates come down, they can refinance into a lower payment. If somebody is on this call still waiting until rates come down, you're more than likely going to pay a lot more for the house, because people are payment driven. And as rates come down, people are willing to pay a little bit more for the same house. So it's best to get locked in, marry the house, and date the rate.
Yeah, I love that. It's such an easy one to remember in the concept.
And it makes sense.
Yep, so easy. Jay, anything else that you want to add for our listeners here, or anything that would be of value?
No, just know that my team and I are available to chat with any questions that might have popped up as you're listening to us.
Yeah, it's absolutely a great thing to have a resource like Jay and his team. And just like I said, it can be the reverse mortgage side of things and information gathering, or you're in a situation that you need to refinance or you need to get into a new home or whatever. Jay is a fantastic resource along with his team.
Fantastic. Great show today.
Yeah, absolutely.
Jay, great to have you on the show. Another huge get for a guest today, Nikki.
I agree. I like when we can have Jay on a couple times a year. It's such a big piece of people's financial picture. So, yeah, go ahead, Tony.
All right. Well, yeah, and I think it's really helpful because a lot of people just don't understand the ins and outs or what's happening with mortgages and what options they have. So, Jay, that's great. And listeners and viewers, that does it for today's episode of Paladin Financial Talk.
Woohoo!